Good morning. On behalf of our entire team, I'd like to welcome everyone to our 2015 Horizon event. Starting us off will be Ben Breslau. Ben's an international director with JLL. He heads up a research department of over 150 people in the Americas. Ben's been with JLL for over 10 years. He's a member of our executive committee that guides a research department of over 400 researchers worldwide. So with that, Ben.
Thank you, Barry. Welcome, everyone, from me, too. It is an absolute pleasure to be here with you this morning. And I was honestly flattered to be invited to this. There's a lot of competition for speaking spots like this. Until I found out that, first of all, I was runner-up to Janet Yellen, who said no, she couldn't make it. She's speaking somewhere else today. And secondly, Barry and the JLL Executive Committee sat around the table, and they wanted to be in keeping with the theme. They thought, who is the absolute biggest nerd in JLL? Because we want that guy on stage for our event. And so, but anyway, I'm really happy to be here. I'm going to try to take you through really three things this morning to set the stage, talk a little bit about some of the trends that Barry already touched on. The first is some of the unsettling macro headlines that are out there. It's really hard right now to be up on stage and talk about anything micro in terms of what's going on here in Denver with the nerds without talking about the macroeconomic environment, which is a bit unsettling. Then we're going to take a look at within that environment where we see opportunity. You may, as a look ahead, hear about some more nerds in that discussion. And then we're going to talk a little bit about Denver in particular, and hopefully that'll set up Peter and the panel. So I'm going to start with some of these unsettling headlines. So everybody's talking about China these days. The China's a mess. This was an Economist cover from the last week in August, the Great Fall of China, and a Wall Street Journal article from earlier this week about the factory index that everybody watches in China as a leading indicator going to its lowest level in 6 years and foreboding really bad things in China. So I like to step back and try to level set a little bit about where we are in China, because I think it's important to step back from the big headlines. So first of all, China is slowing. But the stock market crash that has been witnessed in China is not necessarily indicative of a disaster economically in the marketplace. First of all, stocks, yes, they're down 40% in China over the last 3 months, which you definitely consider a crash in the stock market. But if you go back just 1 year ago, the Chinese stock market is up 30%, which beats most other indices around the world by a wide margin, including the US. Furthermore, if you try to look at all these predictors who are saying the stocks went down, it's an indication that everybody's bearish on China. If you look at the correlation between the movement of stocks in China, the equities market, and the Chinese economy, it's basically zero. The probability of guessing right based on where stock market's going, where the economy's going, is almost nothing. And by the way, that's true in other places too. In the United States, we've had 14 stock market corrections in the last 3 decades and only 3 recessions. So watch the stock market, but it's not always the best indicator of where things are going. So what's happening in the actual Chinese economy? The official growth target is 7%. The actual growth target, that's not a typo, it's a question mark because no one knows. Part of that is because probably there's some smoke and mirrors going on there, and part of it is because China, in fact, is transitioning from an export, manufacturing, and infrastructure investment-led economy to a consumption-led economy and a domestic economy. And that is not an easy transition. Any country that's been growing as fast as China has been growing will have a bumpy ride in that transition. In fact, it's a transition that Europe has gone through in the past, and the United States has gone through in the past, and Japan has gone through in the past. China's going through it too, and there are some macro trends that I think I would personally not bet against for the medium term in China. And by the way, the lower growth rate in China is partially just due to the law of big numbers. So the absolute growth in China over the past year is actually twice as big as the absolute growth of China in 2003 when it was deemed the miracle. Over the next 5 years, there's going to be an additional 100 million people that move from rural areas into cities, and by 2050, something like 600 or 700 million people. That's double the population of the United States. So again, when you step back from the headlines, I think there are definitely issues in China, pollution and overbuilding and the government's ability to manage. But I think it's not quite the disaster that everybody thinks, and I wouldn't personally, in the short term maybe, but in the long term bet against it. Some of the other headlines. Oil, obviously near and dear to the hearts of people here in Denver. Oil prices are down, I think the latest reading, 65% from the peak, which happened in 2014. And that's had an impact certainly on producers around the world. The flip side of that is the positive impact that it's had on consumers. And I'm going to get to this in a minute. The U.S. is largely a consumption-based economy. So it's actually, I think, on net, a positive. But in terms of specific economies, more so places like Calgary and Houston, but to a lesser extent, but a meaningful extent, places like Denver, it's a headwind. And certainly in the office market, we've already seen something like 500,000 square feet of space come back from oil and gas companies in the energy sector. If oil stays in the range, it's been range bound between sort of 45 and 55. If it stays in that range, which we expect it to for the next 18 to 24 months, given the supply and demand dynamics and given what's happening in China, we think that there could be a little bit more negative impact on the office market here. But I'll talk a little bit about some of the counterbalancing positive things there as well. So the oil is obviously partially the supply and demand side. The supply side, where U.S. has ramped up production, it's partially the demand side. There's no doubt that global demand is down. Global growth is down. The forecasts for global growth have been steadily decreased over the past few years to now where we're just between 2.5% and 3% this year. If you look at the kind of the little upper middle part of that, where the world and the United States are, looking to accelerate slightly next year, but really the potential growth rate of the world and of the U.S. has slowed, and that's not a comforting thing when you're building buildings and delivering and trying to gauge new demand. There's a couple things going on here. One is that Japan and Europe are steady now, but really kind of stagnant growth, struggling with a variety of different problems. And the BRICS, these great emerging markets, which were powering us out of this recession when the U.S. and the other developed countries were struggling, have really taken a back seat. I usually say now the BRICS have become the ICs. You can see Brazil and Russia at the bottom. And with China faltering, even the ICs are a little icky these days. India has, without a lot of fanfare, has overtaken China as the top of the heap here. The story I take out of this partially is that the U.S. is in really good shape globally, but the global market is tough. So this is weighing heavily on the minds of the Fed, certainly when they met last week and decided not to raise interest rates. There's a big raging debate, and obviously the markets have been a little bit unsettled given that everybody's trying to figure out what the Fed is going to do. I step back and look at this and think, okay, the Fed actually does have a dilemma here, and I won't go through everything on both sides of this ledger, but there's actually a reasonable argument to be made, I think, on both sides of what the Fed should do right now. The case against, which is clearly the one that they went for last week, says that the unemployment rate is actually misleading because there's all this slack in the labor force due to the participation rate and due to people who are working part-time instead of full-time. Inflation is way under our growth target. And by the way, the dollar's strong. It's hurting parts of our economy. And the slide I just showed you, the global demand is really weak, and now the financial markets are jittery. We don't want to spook the markets. But I think there's a decent case for as well. Unemployment is down at about the level that they typically like to see and where inflation tends to kick in. And if you step back and look at the U.S. economy, we are employing more people. They are making more money than ever before. They are buying more goods and services than ever before. And corporate profits are at levels we have never seen before. So if you step back and look at it like that, we are actually, from a domestic perspective, in pretty good shape. I think there's more confusion over will the Fed do it or will they not, and more negative impact on the markets over will they do it or will they not than there would be if they just got going, put an eighth of a point or a quarter point on the board, and at least showed a trajectory. This is likely to be the most dovish tightening cycle we have ever seen. It's going to be low for a long time. And so obviously, there's a lot going on here. The question that Janet and her colleagues are really struggling with, I think, are, in addition to the inflation question, can the U.S. withstand the global weakness that I talked about? I promised I wouldn't show too many hardcore economic slides here. I know this is a fun group. There are JLL people out back with oxygen tanks if anybody feels like their head is going to explode. I promise just a couple of slides here that I think make an important point in a positive way about the U.S. economy. So what you're looking at here are two indices that are used as leading indicators of two important parts of the economy, the manufacturing side and the non-manufacturing side. The red is manufacturing. What you can see is a distinct downward trend. That's due to the strong dollar and the fact that exports are down because of the global weakness. But manufacturing is not the majority of our economy. And if you look at the non-manufacturing side, it's going straight up, and the indicators, including some that came out this morning, like jobless trends and the housing sales, which were both beat the consensus estimates on the positive side, is going up. So the question is, can the non-manufacturing really lead us through the global weakness? And I think there's some of the answer in history that says it can. You can see that divergence if you look all the way to 2015. These are slightly different gauges, but again, the red is the export kind of manufacturing part of the economy. The blue line is GDP, and the tan line is domestic demand. We're a 88% domestic economy. In 1998, the global market headed into the tank because of the Asian financial crisis. There was a lot of concern about we're going into recession. But if you can see, the domestic economy was very strong at that point. It's not quite as strong now as it was then, but it's sturdy. And GDP stayed much closer to that domestic line than it did to the export, globally sensitive line that went down. I think we're going to see the same thing right now, and it gives us cause for optimism that we can power through some of this global weakness. Now, with all these sort of scary indicators out there, I wanted to make sure to show you that we're looking at a wide range of indicators and news sources here to get the real scoop. I promise when I get into the hardcore economics, I got to go to a joke to follow it up to make sure people are still with me. So, citing The Onion, the America's finest news source, citing their recent availability and consistent quality, a report released Monday by the Brookings Institution confirmed that as far as oyster crackers go, the nation is doing pretty good. So we should all feel very confident. Goes on to say, and this is very technical speak here, the United States is currently in a very respectable place in terms of oyster crackers, and at present, and existing oyster cracker-related concerns are minimal. So again, if we put in the bad news in China, the global issues, what we see as positive in the domestic economy, and of course, the famous oyster cracker metric, we actually see some optimism for positive growth and continued expansion in the U.S. economy. So this is the backdrop to say we think this cycle has some legs in the U.S. despite all of the trouble around the world. We've got room to run on the consumer side. We've got room to run on the housing side. And our view is that we have a fairly low, not none, but a low probability of recession this year and next year, but an increasing probability of recession between now and the end of the decade. The longest expansion in U.S. history, which was in the 90s, lasted 10 years. We're in year 6 of this one. So it is getting mature, and that has to impact some of your decisions in terms of occupancy, in terms of investment, in terms of figuring out where you find opportunity, knowing that, again, this is not going to be perfect, but we see a good 60 or 70% chance of recession in 17, 18, or 19. So the property markets, given where we are, given that the U.S. economy is humming, are doing great. This is the property clock. Some of you may have seen this before, famous JLL property clock. The right side of the clock indicates sort of falling markets or markets where rents are declining and demand is not that good. The left side of the market indicates rising markets where typically you have positive demand, falling vacancy rates, positive absorption, and rent growth. So this is a national look at kind of the leasing markets. All the major property types are aligned on the left side of the clock, which is a good thing for investors. It means that the market is coming to you and tightening. It's a good thing for tenants, too, because it tends to mean your businesses are going well, even though costs might be going up as you're trying to lease and acquire space. Multifamily has been out ahead in this cycle due to the millennial boom and the shift toward renting, but it's got the most supply in the pipeline, including places like here in the urban core of Denver. So we see it continuing to do well, but moderating in terms of rent growth a little bit as some of the new supply softens. Hotel, industrial, and CBD are really in the sweet spot right now of this cycle, where you see really strong rent growth, very solid absorption, and new construction starting to come out of the ground. True in Denver, too, which I'll get to in a little bit. And suburban office and retail are lagging a bit, but certainly coming up the curve, starting to see good rent growth and accelerating in this part of the cycle. Each of these, by the way, in addition to the supply and demand dynamics, are dealing with structural shifts that we spend a lot of time thinking about and talking to our clients about. So you think about e-commerce impacting retail and industrial. If you think about the changing use of office space and the changing center of gravity of office markets impacting where people want to work and where they want to live for that matter. You think about retail, as I said, the change between the clicks and the bricks. So there's a lot of sort of cyclical and structural things we're watching, but we think we're in the sweet part of the cycle. So if the markets are booming, that means it's competitive out there, whether you're looking for space or whether you're looking for investments, and the cycle is maturing, meaning the end is not imminent, but sometime near. Where do you find opportunities? And I'm going to give you my secret source. I don't usually like to give this up, but we actually like to ask the nerds, which is why they bring me up on stage. And I'm not talking about your traditional nerd, this really smart guy who's also very socially awkward. Although I have to say I love his JLL color suspenders and glasses. We're talking about the modern nerd. We're talking about millennials. We're talking about innovators. We're talking about hipsters. We're talking about the young knowledge workforce that all of the corporates that we talk to and the tenants and occupiers that we talk to are trying to get, and all of the investors are trying to figure out where are they going to go next and how do we get in front of that wave. So, what do the nerds want? These are all kind of the buzzwords that you see, and this is some of the things that went into our analysis of where around the country. And we tried to look beyond the primary markets, obviously, because some of the primary markets, which are really hot right now, also have a lot of these characteristics as well. But we've tried to look at where do you find this mix of opportunity, of quality of life, of affordability, of character, of collaboration, transit-oriented, the cool factor, the vibrancy, and that's where we came up with the nerds. It's very fortunate for us that we picked the acronym first. We happened to find markets that fit the acronym. That's the scientific way we do research at JLL. But actually, this is really interesting when we started to study into this. These are markets, and Barry touched on this before, to which people, especially millennials and young people, are moving in droves, and where the economic output and potential of those markets are currently humming along at a clip of over 2 times the U.S. average. These are markets that are a little under the radar maybe from the big primary gateway markets, and therefore markets where we see outsized opportunity, not only in the rest of this cycle, but markets where we feel like there's a potential for an inflection point and where you want to be over the long term. So, and you think about, I'll pop through them quick, you think about places like Raleigh-Durham where obviously you have the research triangle and education prowess and healthcare as well, and a big technology pool, affordability, and a great talent pool there. Nashville has really come strong on the scene in this cycle. Also, huge healthcare sector, and including a growing health tech sector there. It's got the cool factor of the music scene as well, and great affordability. I'm going to talk about Denver in a minute. Salt Lake City, in addition to the highly educated workforce there and the affordability factor, especially as compared to some of the other big markets on the West Coast, you've got major occupiers, probably from finance with people like Goldman Sachs and Fidelity, who have put their thumbprint on the marketplace. I was amazed when I heard that Goldman Sachs, Salt Lake City is the 4th largest location in the world for Goldman Sachs. Pretty smart group, right? So it's New York, London, Bangalore, because of all their outsourcing. Number 4 is Salt Lake City with close to 2,000 people. So again, you want to sort of follow the smart money. That's probably where it's going. And then you've got this whole tech wave there with Adobe and Cisco and Microsoft and the Silicon Slopes, which has really made Salt Lake City pop. And then the East Bay and Oakland is benefiting from the heat that's emanating from the San Francisco and certainly Silicon Valley. You've got the same talent pool there. You've got better affordability. Office rents in Oakland are 50% less than office rents in San Francisco, and probably 70% less than office rents in Palo Alto. And it's again the same. You've got the same talent pool there. You're on transit in Oakland. You've got these cool hip submarkets like Berkeley and Walnut Creek and others. And just 2 days ago, Uber, one of the big new tech companies that's gobbling up space in San Francisco proper, made a commitment to buy the old Sears building in Oakland, 330,000 square feet, to expand 2,000 employees into Oakland. So again, these are markets that haven't arrived yet but are coming up the curve quickly. And as I said, they're just cranking from an economic and demographic perspective. Follow the people, follow the jobs, follow the millennials, and you should do very well. Denver in particular, if we look at it, is punching above its weight. Denver is the 21st largest metro area, but it's got the 9th highest education levels. It's got one of the best airports in the country and in the world, and therefore one of the busiest, and great sort of infrastructure in transit in general. You've got among the fastest growing populations in the country, and you've got, going back to my comment about energy, I think this is really important, the 8th most diversified large metro area in terms of the industrial mix, okay? So if you actually look to do some correlation studies between, for example, office rent growth and different sectors of the economy, you get a higher statistical correlation with tech than you do with energy, and also with things like transportation and warehousing than you do with energy. So again, that shows, I think, how diverse actually this market is, which it doesn't always get credit for. In addition to the statistics, though, I think there's a lot of things that Denver offers that investors and occupiers and residents and employees are looking for. One of the most important ones, which I think is talked about a lot but still underrated somehow, is the fact that it's got this vibrant urban core. If you look at the primary markets, mostly have those, but the secondary markets, if you think about markets like Dallas and Houston and Atlanta and Phoenix and San Diego and some of the other markets that get lumped into that sort of secondary market group, most of them have sort of hubs that are either suburban nodes or midtown, uptown kind of nodes, but they're lacking the kind of true, vibrant urban core. And Denver has grown that in a really nice way, especially with these new emerging submarkets like Lodo and Rhino and Uptown, which I think you should call Upto, just to stick with all these little acronyms. But nobody's taken my advice for that yet. But I think again, the vibrancy of the marketplace is something that's part of why people are moving here, and that's why employers are coming here, and therefore investors are coming here. And it's got other ingredients too that don't always hit the statistics, but I think they're good, actually really good leading indicators. One of them you see in the middle, Union Station here. I think the infrastructure, the U.S. News and World Reports recently ranked Denver the best public transit system in the country, ahead of New York, ahead of Boston. And I think the investment that's gone into not only the Union Station and the airport, but the rail and the expansion of the rail and bus is just amazing here. But you also have the quality of life factors that are just amazing. People always talk about the 300 days a year of sun, which is maybe overplayed for all of you that live here. I'm from Boston. It snowed 300 days in Boston this past year. Trust me, it did. I think it was consecutive days too. You guys have snow. If you want snow, you can go ski on the snow, but it doesn't snow as much as. So anyway, I think that you've got the beer festival coming. You've got this foodie culture, which I actually think is an underrated, great leading indicator. These towns that sort of crank up the cool foodie culture. This is a great quality of life and great place to be. And you've also got a flair. I think that's Barry's weekend garb for the Broncos game in the upper left. And I just learned also about raise your hand if you know what a shot ski is. Okay, raise your hand if you've done a shot ski this morning already. Okay, so I just want to check. For those of you who are out of town like me, apparently you line up shots on the ski, and that's how you get going in the morning. But my point is, you've got these elements that there's a soul. The millennial talent that we talk to, and we do a lot of surveying of millennial talent, there's all these statistics. You want to be near transit, you want to have an urban core, you want to have growth, you want to have economic opportunity. But when you really get down to it, they want a place with character. They want a place with a soul. They want a place that's authentic, that has a quality to it that they can belong. So I think Denver obviously has that. And investors have taken notice. The people usually come first, the occupiers follow the people, or the people sometimes follow the occupiers, and investors tend to follow that wave. But this is a recent ranking that we call our Global Investment Intensity Index, and it ranks a little bit different than you normally see. Normally you see investments ranked by just by volume. What we did was we ranked investment volume across all property types as a ratio to the GMP, so the economic output of the market. So it gives you a sense of where markets are as compared to their size. Otherwise, it would be sort of unfair comparison. And what's amazing to me, which you would not have seen 10 years ago or certainly 20 years ago, is Denver on this kind of global stage. 1 spot behind Washington, D.C., and 2 spots behind Tokyo in terms of investment intensity. And then if you shift over to the right side of the slide and you see where we look in the U.S., also amazing to me, you've got a handful of markets that aren't considered sort of primary markets on this top 10 list of investment intensity, meaning the amount of investment coming in given the economic size of the market. Honolulu, everybody wants to go to Hawaii, so that one's kind of obvious. And then you've got a couple of tech markets like Austin and San Jose that maybe aren't primary. But other than that, it's Denver on that top 10 list with all the primary markets. And what I think investors are seeing, the ones we talk to, is primary market attributes at a secondary market price. And I know pricing has been escalated here. It's getting a little bit more expensive. There's been a lot of competition. But what you're seeing is, I think, a great opportunity to buy into some primary market attributes, again, at a secondary market price. And you can see if you go down the list, all of the rest of the nerds are all sort of punching above their weight, so to speak. And if you drill into the Denver property markets for just a second, you see a similar trend that I showed you on the national property clock before, where really we're in the sweet spot of the cycle for Denver. Pretty amazing statistics here. If you look at multifamily, Denver has had, I think, the highest rent growth in multifamily across the country in the past year of any market not in the Bay Area. Now, there is construction coming in the pipeline, specifically concentrated, I know, in Lodo and around Union Station. And there will be a little bit of softening and probably moderation of rent growth in the near term. But if you look back and take a wider scope at Denver, the housing production, the residential production overall, has actually been running at a deficit. And we think because of the in-migration, the population will be in great shape. On the office side, you've got a little weakness from energy, but you've got strength from a lot of other sectors and positive absorption and rent growth. And rents that, by the way, are still 20% below the national average and 50 to 60% below those other primary markets that I showed you in the list on that last slide. So again, a compelling opportunity for occupiers and a compelling opportunity probably for rent growth for investors. And industrial, this is a regional distribution market from an industrial perspective, but the second lowest vacancy rate in the country behind only LA, which is the largest industrial market in the country. Retail has been really active. We're actually projecting, although retail's been slow, you saw on the property clock to come up the rent growth curve, we're actually projecting increasing rent growth in the retail sector, especially in kind of the A space and the infill high street kind of retail space that could crank at 4 or 5% over the next few years. So we see a lot of opportunity in retail. And the hotels here are more full and have been more active, by the way, on the investment side than a lot of other markets in the country. I think it's important when you look at the property types, and I'm going to zone in on office just for a second here, that it's not, the uses of space are changing. I talked about this a little bit before, but this wave of millennials, these young workers that are here, are changing the dynamic of what's in demand. So it's not just what you built before or what you owned before. You've got to be in the wave of this cool factor. It's not okay just to have a building with space. You've got to be able to check the boxes of all those buzzwords, or as many of them as you can, that the millennial talent and therefore their employers are looking for. So it's open space, it's collaborative space, it's bike racks, it's roof decks, it's amenities, it's access to transit, all of those things that Denver's doing really well, and it's, I think, part of the reason why it's doing so well with millennials. It's not all rosy in the sense that there are some headwinds, I think, to look at here, in addition to the headwinds on the global scale. I've got some of them up here. I just mentioned some of the changing tenant requirements that I think actually will be a governor on overall growth in the market in terms of the density factor. Although at the leading edge, we're actually seeing some of that swing back a little bit, where tenants are saying, I need more private space, and I need, we can't all be on benches. Certainly, you've got the energy sector, which I talked about. You've got valuations going up, which is going to hit real estate taxes through assessments and could hit affordability a little bit. You do have rent growth on the renter side that has been clipping along at a much faster rate than wage growth. So you do have this allure of being an affordable market that you run the risk a little bit of some of that going away. Statistic that I read the other day, though, was that I think there's going to be 100,000 new households created in the next 5 years in Denver. So I think renter demand and housing demand should continue to be pretty strong. And then obviously you've got construction in multifamily. You've got some construction starting on the office side. So keeping an eye on that in a market that has overbuilt in the past is always something to look at. But when we step back and sort of wrap this up and give you our outlook, we think that the U.S. is in a pretty good spot despite all of the scary headlines. My advice to you is don't read all the headlines. You'll want to shoot yourself, and it's not that bad. The opportunity, we think, is to look at those markets that are hitting an inflection point. The nerds, we invite you to look at some of our research on the nerds and talk more about that. And we think that Denver in particular is really well positioned to be, in this cycle, really shifting from where it has operated to really a next level kind of primary market or high secondary market that is attracting and will continue to attract a lot of talent, a lot of occupancy, and a lot of capital. And with that, I will thank you and turn it over to the panel.